we get inflation data out of the Eurozone. Inflation doesn't seem to have been a problem for a while. And in fact, the German data of yesterday suggests that it might be a problem in the other direction, a little bit lackluster on the inflation front. So what are we expecting?
Yeah, I mean, I think you're exactly right. Inflation's not a significant problem, and so I don't think we will get a huge market reaction. The ECB's been very firm that 2% is their good place. Now, because markets are kind of anxious about what the next cycle looks like, and we haven't had significant economic damage that would usually accompany a kiting cycle, that means they're looking for a hiking cycle next. Now, it's priced 2 years out, so the question is, can that be brought forward to impact market pricing? The issue is there's not really a good reason for it, as in you have your policy rate at the midpoint of neutral, so you're not excessively loose, and you also have inflation, as you say, that's coming down, and today is likely to surprise to the downside if yesterday's inflation prints more regionally are any kind of indication. Now, I think because that hike pricing is so sticky, it means that you need a pretty significant downside in inflation, or more likely growth worries need to come to the fore pretty prominently before you start thinking about cuts again. So it just means that you're a little bit stuck in Europe, and markets can keep looking for what justifies a hike, but there's just not really that evidence.
Are other things moving the euro rather than things that are kind of within the euro's control, i.e. ECB rates, etc., European growth, moving the euro? Kind of what is moving it right now?
Yeah, absolutely. I think rate differentials have been kind of your number one driver in recent periods. And because you're not getting that movement from European rates, you need to look for US or US rates. And I think, it's not only a rate perspective, but also geopolitics we need to think about quite significantly right now. And it's important that the US dollar has returned as a safe haven. So it is getting that bid when we get these bouts of geopolitics. You've also had a lot of US data coming out on a regular schedule now. So we're getting kind of more impactful data because it's actually relevant, or it's time near, and we're thinking about, how many cuts can we get from the Fed? Can we get cuts at all this year? And so we'll get jobs data later today that are kind of the precursor to the more important data on Friday. But, the U.S. side is certainly driving more, and it's against an environment where euro positioning is still very long.
Just briefly on yields in Europe, there's a bit of a bid for European sovereign debt today. Are yields kind of capped in Europe? There was a bit of a sell-off that we saw last year on the issuance out of Germany around infrastructure and defence. What is the story in terms of whether or not these yields are capped at this level? Yeah,
I think you're certainly anchored by your policy rate, and I think range trading is what you'll likely see, and part of that is just where's the fair value for yields. I think both at the 10-year and the front end, you're pretty close to that. On the 2-year in particular, if you think about the 2-year trading very closely to the policy rate, then your 2.1% or wherever we are, it's just slightly above. So that fits with a market that's looking for a hiking cycle next, but isn't really sure of where that's coming, as well as if you just look at like 1-year, 1-month OIS and 2-year, 1-month OIS, being between those two looks about right.